Can we start by spending some time discussing what's going on in markets today? We've seen a really sharp sell-off in global equities over the last few weeks. And, as we chat today, global equities are down 5% from the end of last year. Now, the weaker parts of the tech complex, so, that bottom quartile of the NASDAQ, began to sell off towards the end of last year. But that's accelerated into the new year, and it's expanded into the more widely held large cap tech names. So for example, you have Netflix down almost 40% this month. Zoom's down another 20%. Tesla's down 20%. These are some quite large moves, and that's just this month. Zoom has fallen almost 70% from its all-time highs. Netflix has halved. Tesla's 30% lower. Can you take us through what you're seeing in markets?
Sure. Quite simply, we're seeing a repricing of risk as real yields have risen. Real yields and real GDP growth have typically trended together. The real yield on the 10-year US Treasury bond fell to around, or just over negative 1% at the end of last year. If you want to use spot inflation, it was actually negative 5%. Arguably, the bond market was pricing in the worst slowdown in economic activity in 50 years, which was at odds with what we could observe in the real economy. Even with the pace of economic growth slowing, the outlook for activity, along with stickier inflation and Fed tightening, suggested both nominal and real yields were too low. We've been talking about a normalization in real yields for some time now. That process has now started. And higher yields triggered a sell-off in weaker companies and companies with high starting multiples that, all else equal, have far greater sensitivity to rising discount rates. We knew a normalization in real yields would be a risk to the growth long duration trade, and we've been actively avoiding exposure to expensive growth. Instead, we've been focusing on resilient businesses that are cheap relative to their growth profile. So we have been well positioned to weather the storm over the last few weeks. And pleasingly, across the global portfolios, it's been a strong month for alpha.
Do you think the bulk of the normalisation in real yields is over? And, is the correction that we've seen in global equities over? That correction we've had over the past few weeks, is that done?
Look, despite the moves, I think the growth long duration trade still looks vulnerable. The Fed hasn't changed its rhetoric. Asset purchases will conclude in March, and we could see the first rate hike fairly quickly. And the market is now starting to price in up to 5 rate hikes in 2022. This drawdown feels similar to fourth quarter 2018, where the Fed was tightening into a slowing global economy, which had been led by a Chinese slowdown. The S&P fell around 20% before the Fed pivoted and cut rates to support the equity market. But the Fed may not be able to save the day this time around because of inflation. December's headline inflation print was 7%, and even with supply chain bottlenecks easing, we have pent-up inflationary pressures in wages, rent, and energy prices, which can keep inflation elevated for the rest of this year, particularly in the US. There seems to be a mismatch between the supply of labour and the skills that are in demand, which is keeping wage growth elevated and rents are rising because of a property bubble. Sticky inflation may prevent the Fed from reversing monetary policy, even if economic activity is weaker than expected. Look, commentators are correctly calling this, the end of the Fed put. And we have to remember the S&P is still only around 10% off its highs from the end of last year. The long duration trade has borne the brunt of that correction, but we're really only just starting to see the sell-off broaden out. Retail investors have supported the market in recent sell-offs, but retail is more geared than ever. Margin debt in the US is close to 4.5% of GDP, which is a 20-year high. If the S&P falls further, retail investors are going to start feeling more pain and at some point could hit the panic button. But look, even with economic growth slowing in the US, the data suggests the economy is still in a relatively good position. And in the stock market, multiple dispersion remains elevated, which means we're seeing opportunities in both the long and the short side. Our capital preservation process is focused on resilient businesses that can take profitable market share in a high inflation environment. And this is important because corporate profitability will suffer with higher inflation. You want to own market leaders that can protect their profitability by increasing prices or pushing back on suppliers. In the long-short strategy, we're shorting weak and expensive businesses across both the growth and the cyclical buckets.